In this video, I'll be going through what I believe is my investing style in the Malaysian stock market in 2021, and I'll share 2 stocks that fits into this investing style to all of you. Cha-ching! Following my usual style in the US market, I usually go for high growth but high risk stocks that have the potential to double or even triple my investments. I started off this way too in the Malaysian stock market, with my purchases of both GDAX and Revenue Group firmly in line with this growth investing style that I've always had. However, I'm starting to reconsider things. In 2021, I'm thinking of shifting my Malaysian stock investments from a growth investing style towards a more dividend style. To be completely honest with all of you, I've not been the biggest fan of dividend investing ever since I started my journey. It gives me a bit of money here and there, but when our capital is not that big, do I really need it? For example, if I had a capital of, let's say, 10,000 ringgit with 7% dividends, it'll only be around 700 ringgit a year, which of course is a nice passive stream of income, but do I really need it this young? I'd probably be better off putting all of my money into growth stocks that, yes, may be more risky and volatile, but have the potential to double or triple my money. So much so that I even considered making an entire video about why dividend investing is not for me. Well, here we are today, and of course, it's never good to say never, because looking at the Malaysian stock market, there are some appeals to it. We'll save that for another video though, because looking at the Malaysian market, things can be a bit different. Let me explain why. The first reason for this is that I'm afraid that my growth style of investing would not fit all that well in the Malaysian stock market. Usually in my foreign investments, I look for disruptive companies that are really going to change the way we do things, like for example, e-commerce and fintech this year. Unfortunately, I haven't yet been able to pinpoint the companies or the industries that do a similar thing in Malaysia. Maybe I'm just not good at it yet, or I haven't gotten the hang of the Malaysian stock market. But if you guys have any ideas about growth stocks, then let us know down in the comments below. But the largest companies in the KLSE are usually the traditional banks, telcos, or people involved in oil and gas or plantations. There's not much of, the Netflix and the Shopifys of the world, so it's a bit of a different market, which is why I'm thinking of changing my style of investing. The second reason that I didn't want to invest in dividend stocks in foreign companies is because all dividends paid by them are actually subject to a withholding tax by their respective governments. For example, all dividends paid by US companies are subject to a 30% tax that they will actually take away before even it reaches us. When you rely on a 6 or 7% dividends every single year, a 30% cut will really be detrimental to your plans. If you're a Malaysian investing in Malaysian stocks that pay out these dividends, you won't have to pay any tax on it because the Malaysian tax rules are very favorable to investors. This way, I'd actually get the full dividend amount that they're paying me, and I can even use it to buy more shares through programs like the dividend reinvestment programs, which usually get us shares at a better cost basis. A dividend reinvestment program, or a DRIP, is something that some companies like to hold, where they tell investors that, hey, instead of the dividends I'm going to pay you, why don't I give you more shares at a better cost price than it is right now? Having said all of this, I've decided to go through the entire Malaysian stock market and look for the best companies that pay out healthy dividends, and 2 names really stuck out to me. They're of course both listed on the FBM KLCI as part of the 30 largest companies in the Malaysian stock market. The first one that I'm looking to invest in is our banking giant, Maybank. They're currently worth just under 100 billion ringgit and pay out a juicy dividend of 7.5% annually. That's 50% more than what ASB gave us in 2020 in terms of dividends, but of course these two aren't meant to be compared, it's just a thought. They've actually held the crown of being the largest company in Malaysia for a while, until this year when Top Glove threatened them for reasons I'm sure all of you know why. Maybank is my bank of choice in terms of managing my financials, and I actually like the fact they're the most innovative of the bunch. It's actually one of the reasons that I chose Maybank instead of something like Public Bank, which in its own right is also a very good stock. But it's much better for us to invest in stocks when we actually use the products of the companies, right? It's also very, very refreshing to see that Maybank is not resting on their lead as the biggest bank in Malaysia and actually investing more money into their business with things like launching May and having an e-commerce like acquisition strategy with Maybank QR Pay. I guess Maybank QR Pay isn't really an e-wallet, but they're investing very heavily to compete against the likes of Boost, Grab, and Touch and Go, and they're actually trying to win this market instead of just launching a product for the sake of it. In terms of financials, their revenue and margins have actually recovered from the blip in Q2 of 2020, which is nice to see as the country goes into recovery mode in 2021. Usually, I don't really like investing in bank stocks, and this year has actually made things worse. Governments across the world have reduced interest rates by so much, and Malaysia isn't exempt from this. Generally, when interest rates are lower, banks make less of a profit because there's less margins for them to take. Also, a shift toward fintech, which of course I've talked about a lot, may mean that customers use less of traditional banking methods. However, Maybank's efforts to acquire younger customers and continue staying up to date with the latest tech in the industry gives me good reason to believe that they will perform well in the next few years at least. Even as a customer, I use a lot of their digital products like Maybank To You, Maybank QR Pay, and sometimes even May, which are all actually very convenient to use. Owning some shares of Maybank is also good for my portfolio because it gets me involved in the so-called recovery play of 2020. To explain on this a bit more, a lot of people see stocks in two categories this year. The first ones are actually those who have benefited and are actually skyrocketing with positive performance year to date. While the second group, which is basically the airlines, the banks, the cruises and hotels, have actually lagged behind of course and are still down year to date, but as the economy starts reopening, they are considered the recovery play since they have more room for growth. Since nearly my entire US stock portfolio is in tech investments, which has actually shot up already this year, it'll be nice for me to have a bit of exposure to some of these recovering industries. I've considered rebalancing my portfolio for a while and trimming some of my high growth stocks into some of these recovery plays, but I haven't really done it so far, so I think investing in stocks like Maybank is a perfect choice for me. The stock was actually trading at just 7 ringgit in early November, but ever since then, it's recovered all the way to around the 8 ringgit 50 cents mark today. Some people may think that, oh, that's a very big increase, so I'm not going to buy until it go back down to 7 ringgit, but personally, I just don't think we'll see that again. They're also the first bank in Malaysia to declare dividends in 2020, and it could be seen either as a reckless move or a sign of confidence about the future in the business. I prefer to believe it's the latter, where the management thinks that things are really starting to turn around and they don't have too much worries about their assets or cash flows, which is of course a good sign. I don't see this stock giving investors massive capital appreciation in the near future because it's already so large at around 100 billion ringgit market cap, but collecting a nice 7.5% dividend every year isn't too bad, is it? The next company I'll be looking to invest in is Tenaga Nasional Berhad. The company currently has a market cap of over 60 billion ringgit, and I believe it's in third spot in terms of largest behind Maybank and Public Bank. Apparently, if you just look at the websites, the company pays out an annual dividend of 9.4%. Everyone put all your money in this stock, we're gonna be rich. This, however, is due to the fact that the company actually paid a special dividend of 50 cents earlier this year, which they don't usually do, and explains why the yield is so distorted. This is something we need to be mindful of when investing in dividend stocks, because when we just filter purely on dividend yield, things like this pop up and we miss out on it and think that we're gonna get so much money in terms of dividends just to be disappointed in the future. On a high level rule, you just gotta expect that there's no way you're gonna get this high of dividends from companies that are this established and this big, because when people see this yield, everyone will be rushing in to buy, including institutions like TNB and EPF. Excluding this one-off special dividend, their annual yield is closer to just over 4%, which makes a lot more sense. While not being close to Maybank's 7.5% dividends, we need to bear in mind that even when we pursue a dividend style of investing, it's not the only thing we look at, because we of course need to look at the future potential of the company and how healthy they'll be moving forward. Being the primary source of electricity supply to the entire country, Their core business is very stable yet unexciting. This isn't the reason why I'm investing in TNB though. Back in 2018, they actually acquired a company called Setia Haruman Technology, which could potentially open up a whole new stream of revenue for them. That company is now called Alo and is a wholly owned subsidiary of TNB, which focuses on developing smart cities through ICT infrastructure, including the provision of fiber broadband services. As part of the country's National Fiberization and Connectivity Plan, or better known as NFCP, they're looking to provide affordable and reliable internet for the development of the country. And I 100% agree with this initiative. A core part of this entire thing is, for one, to increase the coverage of fiber in rural areas, and number two, to increase the speed of fiber internet in the capitals of all states. Fiber technology isn't the best in Malaysia in terms of reliability or even speed. I mean, as a gamer, there's been countless times that I've been disconnected or I see high ping in my games, which really isn't fun. For those of you who are gamers as well, I'm sure you get what I mean. Comparing to our neighbors like Singapore, Thailand, and Taiwan, Malaysia is actually lacking behind a bit in terms of both average speed and reliability of fiber, which is why I think there's great potential for this. In terms of total addressable market, Malaysia has around 2 million fiber subscriptions on a population of 30 million people based on Statista. Assuming a ratio of 5 people to 1 fiber subscription, the penetration rate is only around 33%, which yes is a bit mature, but shows there's a lot more room for growth. I think that the readily available infra of TNB makes this an easily justifiable decision for them to enter this space. It's a move that helps them extend their business, and it's not like they have to put in a lot of money or a lot of new money into investments because they can just build it on top of their existing infrastructure. However, with this still being a investment and competition heavy product, it'll be a bit challenging for TNB to really enter the space and have a meaningful profit contribution in the near term, I think. There's two ways they can monetize this, which the first one being they can lease out these infrastructure to telcos, or the second one where they can actually come up with a customer facing product and decide to compete with the telcos. The entire case for this is still unclear of course, but to me, I see this as a positive sign because it shows that TNB management are willing to expand and take on risks to really grow the business instead of, just sitting back and enjoying their near monopoly on electricity. I think I've said this before, but one of the most important things you have to look at in investing in stocks is how management performs. Another plus point for those of you who are ESG cautious investors is that TNB recently announced that they will no longer be purchasing or expanding any more coal-fired power plants in the future. This is in a bid to shift towards more sustainable options in producing electricity moving forward. They expect that by 2030, revenue contribution from coal-fired power plants will not exceed 20%. In terms of financials, they've actually struggled a bit over the last year, but Q3 has seen a nice turnaround with them exceeding the 1 billion ringgit in profits mark again. They're undoubtedly affected by what's going on this year, which means their stock price is down, and this fits into my recovery portfolio. The stock is down over 20% just this year, and they've actually been in a downtrend for quite a while, but I believe that this will slowly recover over time. There's no risk of them going bankrupt of course, and I'm happy to collect just my 4% in annual dividends while we wait for them to recover and execute on their future plans. If you want to invest in either Maybank, Tenaga, or in fact any other stock in the KLSE, then don't forget to check out Rakuten and use our link down in the description below. You'll get 500 Rakuten points, and of course you'll be supporting the channel as we get a small kickback from the company. Let us know down in the comments below what are some of your favorite dividend stocks in the KL Stock Exchange. If you're ready to click our link and sign up for the Rakuten account but don't actually know how to navigate it, then you can check out this video where we give you a walkthrough of the platform. Give us a big thumbs up and subscribe to our channel if you haven't already. We wish all of you a happy new year again, and hopefully 2021 is a good year for all of us. See you guys in the next one. Peace out.